Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Friday, January 13th, 2023. We're back to update you on all things markets and economies. Had a couple of important data releases this week, namely the CPI, Consumer Price Index. We're going to discuss that with you today and look at some of the clues that are in front of us that are suggesting that the battle against inflation is being won. So let's get right to it. The big important release of the week was Thursday morning, 8:30 a.m., the CPI report, which was showing the activity and the data from the previous month of December 2022. And what we saw was the CPI came in again lower month over month, showing an annualized rate of 6.5%. This is coming down from a peak of 9.4%. So we're moving in the right direction. Again, still an elevated CPI, right? 6.5 is a much too high rate of inflation. But what the market wants to know, what the market needs to see, is that inflation is going in the right direction. And so far on that front, so good. This represented a drop of 0.1% month over month. While it doesn't sound like a lot, any incremental progress moving inflation lower will be a very good thing. Because we talked about this previously, but I'll just reiterate it for those that might have missed it. Right? The market does not need to see CPI back at 2% before the market can succeed to go higher yet again. All the market wants to know is that the Fed has succeeded in wrangling in inflation, that inflation is heading back to where it belongs, around that 2% target, that it's headed in the right direction, and that ultimately will give the market clues and signs that the Fed is reaching the terminal rate or the peak of their interest rate hiking initiative. So when we look at CPI, we want to break it down into its subcomponents to try to get a better feel for where the trend is headed. Because even though CPI is moving in the right direction, we know this tends to be a lagging indicator. In our view, it trails the real economy by 1.5 to 2 months. So we want to look at some of the other components that are calculated in CPI to try to get a gauge on where CPI goes next. Now, make no mistake about it, the market was very happy with this report. This now marks 3 consecutive months that we saw CPI declining. We had a great report in November, another one in December, and one here in January 2023. So first, let's take a look at the CPI index. So there's 2 components of CPI, right? There's the U.S. Consumer Price Index, which is the light blue line on the screen, and then there's the U.S. Core Consumer Price Index where they strip out housing and energy. So again, we don't think the core is really a great barometer because you're stripping out housing and energy, which is 2 of the areas that saw some of the biggest inflationary increases. But nonetheless, the trends are very similar with the 2. So as we said before, we saw a peak in June with the CPI north of 9%, and now we are starting to move lower, and markets are happy about that. When we look at some of the contributing factors to it, right? So in order to get a gauge on where inflation goes next, we should probably look at some of the factors that contributed to the rise in inflation in the first place. And one of the first places that we saw signs that inflation was bubbling up was in the used car index, right? And we see here, after the little dip with the COVID pause on the economy, if you will, used car prices skyrocketed, right? And since that point, we've had a couple little volatile moves here, but ultimately, used car prices now are plummeting, and they're actually at a level now that represents the lowest point over the last decade. So this is a good sign that would suggest certain inflationary pressures are starting to abate. Another thing that we want to look at is, let me just make this larger here. We want to look at transportation rates, right? Shipping rates, because this was another area that we saw inflation showing up hot and heavy, and this was the freight rates, if you will, and this is looking at all different ports, but basically the Baltic Freight Index, where we saw transportation costs just absolutely explode, right? And these are those big steel containers going across the ocean carrying all those goods that we like to buy, and the increase in transportation costs clearly led to an increase in consumer prices, right? Because if manufacturers were paying more to bring the goods over, they were certainly going to charge consumers more for that. So we look, again, very similar to the used auto index, right? Used auto prices flew higher, container rates flew higher, and now they're coming down in a very precipitous fashion. So this would suggest to us, just based on those two metrics alone, that we should see some acceleration to the downside in the CPI for the next couple months. Another thing that we're looking at is very important is the fact that wage inflation is starting to abate, right? So we always love to hear that people are being paid more. We love to hear that wages are rising, but this has been one of the main sticking points for the Fed, right? That they couldn't back off on interest rate hikes until they started to see some of the wage pressures abate. And I would suggest, based on the data we have in front of us, that that is exactly what we are seeing. This is breaking down wage growth across different income distributions, low wage, mid wage, high wage. And you can see, after really being sticky there for a while, we're starting to see these signs roll over, which would say that maybe the upward pressure, the wage spiral that we've been seeing may start to cool off a little bit. Now, at the very same time, right, we are seeing shelter, right? The stickiest component of CPI is also showing signs of starting to ease. So when we looked at CPI as a whole, the two areas that were the most sticky, or the kind of the ones that were the most stubborn, were energy and shelter. And now when we look, right, we know energy prices have come down substantially. You can see that at the pump from a peak of probably $4.50 a gallon here in the Northeast. Now we're seeing prices are significantly lower. And again, we'll see if that trend will continue. We are in the heating season, so oil and gas are being used more now in the winter, but the trend is headed in the right direction. But this is looking at monthly rents, right? So we're looking at the national average of monthly rents, and rents are still elevated, don't get me wrong, but we're starting to see signs that rents would like to head lower. And this will go a very, very, very long way in terms of relief for the CPI, right? Bringing some of those figures down. Because remember, the game here, folks, is that CPI needs to show that it's in retreat for the Fed to feel confident that they have done enough. Now, we are of the view the Fed has done more than enough to bring CPI down, and they should pause and allow a few months for the data to play out. But they're unlikely to do that. They'll raise rates again at the February meeting, and we think the market will take that in stride, very well prepared for that. Now, all the while that we're starting to see CPI easing, and we're seeing certain components of inflation starting to ease, the U.S. labor market has remained rock solid, right? The employment rate remains at historical lows, and this is a good sign, man. This would suggest, right, I know many people's fears is that the Fed rate hikes are going to break the entire economy, and the Fed, right, to their credit, is trying to engineer what they call a soft landing, which would be bringing inflation down without totally destroying the economy in the process. And one of the things that they would hope to not destroy is the labor markets. Now, yes, they do want to create a little slack in the labor markets. They would like to see this tick up a little bit because they think that would go a long way to easing wage pressures. But people are hanging in there. Jobs are hanging in there. We're still at historically low rates, even with some of the inflation pressures easing. And we think that that is a very good sign. Also, consumer services continue to be very strong. This is just one anecdotal piece, but we think it's a good barometer for the services industry. We're looking at Las Vegas occupancy rates now at pre-pandemic levels, right? So this is hotel rooms. People are still going, they're still traveling, they're still getting out there, and this is true in many more cities than just Las Vegas, but Las Vegas tends to be a good barometer on tourism. And again, consumers had a lot of money saved up and packed away from COVID and a lot of the spending that they didn't do that during that period of time. So we're seeing the consumer is out there, they're spending money, and this suggests there may be a scenario here where the Fed can vanquish inflation while the consumer stays strong enough to carry this economy through and potentially avoid a recession. So that's something that'll definitely bear watching. Now this morning, this is a little small, I apologize for the size of the chart, but this morning we kicked off earnings season, right? So we're in January, we're doing Q4 earnings, all the companies from last quarter reporting their earnings, revenue, and EPS. And we're looking at the couple of the bigger ones that reported today. Now, everybody's told us, right? The media has told us, the financial analysts have told us that earnings are going to be terrible, right? They're going to stink. We're going to be in an earnings recession. This is the prevailing narrative on Wall Street. And again, this is just a small anecdotal piece, but so far, and just as a caveat to this, the big banks are always the ones that lead off earnings season. And we like that the banks go first because it gives you a good look into the economy and a good read through of some of that underlying strength or weakness. And when we look at who reported today, Bank of America beat earnings, beat sales. BlackRock beat earnings, beat sales. Citigroup missed earnings, beat sales. JP Morgan beat earnings, beat sales. And then, Wells Fargo, which in my opinion is not a great bank, missed on both. So better than expected, right? Good numbers across the board. Top line, bottom line beats for most of these companies. And I think this is a lot of people surprised. The pre-market change was just how much the stocks were up or down before the market opened today. But a lot has changed since the market opened. We're putting together a nice little rally here. So again, we got many weeks to go in earnings season, but I think this is something that bears watching because the general consensus is that earnings are going to stink, and that may not turn out to be the case. And if it doesn't, if earnings surprise to the upside, they will continue to give this market some momentum to work with. Now, everybody keeps talking about a recession, right? We're in a recession. We're going to have a recession. It's all guaranteed, right? Everybody's telling us that 2023 is the year that we're going to have a recession. Well, somebody should tell that to copper, right? Because it's called Dr. Copper for a reason. Copper tends to be an amazing leading indicator for the global economy because it's a very used building material. It's in so many different things that are construction and building related and industrial related. And generally speaking, I'm sure copper did not get a PhD in economics, but somebody should tell copper that we're supposed to have a recession because right now this asset class doesn't believe it. This type of move that we're seeing here in copper is not something to shake a stick at, and it would suggest that there's a lot more underlying strength in the global economy than one may think. So this bears watching, but I think when we look at the subcomponents of this market, many components are not acting like we're in a bear market anymore, and copper is one of them. Now, let's take a look at the market. So here we are, right, looking at the market over the last 2 years. We'll zoom it in a little bit. Here's the last 6 months. Last week, we talked about the very wide and choppy range that we are in right now. This is the S&P 500, by the way. And what we are looking at here is a very important, I think, a seminal moment for this market. So like we said, there's a little bit of something for everybody in this market. And right now, bulls are really trying to put something together. They got a nice little rally going here, and we're coming into some very critical levels, and I'll lay those out for you here today. So right now, the market is still kind of in no man's land, right, between the October low and some of the recent intermediate term highs. However, market bulls, have a substantial opportunity to put this bear market behind them. But this is not the time or the place to fumble the ball, bulls. So you got to make sure that we continue to have momentum and conviction. Now, what would that look like? We believe if the market, the S&P 500, can retake in a convincing fashion this level, 4,100, this blue line right here, 4,100 on the S&P, and we're just shy of 4,000 now. So, folks, we're give or take 2.5%, 3% away from this level. If bulls can give a meaningful push and get this market above 4,100, we would be confident to say the bear market ended right here on October 13th. But what if bulls are unsuccessful, right? What if the bears step in right before this level and send us lower? Then that means we are going to continue to chop around in this range, and there's a scenario that's likely that we will retest something a little bit lower. So again, unless or until that happens, we continue to read the tape, we continue to read the data and see where this market wants to go, right? We can't inject a bias into the market. The market doesn't care what you want. The market is exactly that. It's a market of stocks, and it's going to go where the flows take it. So this is what we're watching. We've had some conversations with you folks over the last couple weeks, and I've mentioned this level, very critical level. We're getting very close to it. We would love to see a convincing move through this level, right? Compared to some of these previous attempts where the market just couldn't do it, right? We tried to get above, we failed. We tried to get above, we failed. We tried to get above, we failed. Maybe the fourth time will be a charm. So we'll keep an eye on that. And the last thing we want to show you, I think this is very, very important. Let me just bring up one more chart. We believe that we are looking at a historic opportunity in the market as a whole, but particularly in the tech sector. I know a lot of you are tired of hearing about tech, right? Tech was not a good performer in 2022, and everybody is ready to just cast it aside, right? Throw the baby out with the bathwater. Nobody wants to hear about tech. Nobody wants to talk about tech, okay? Very similar sentiment to how people felt about energy stocks in 2020, right? In the first and second quarter of 2020, energy stocks were cratering. They were crashing day after day after day. Nobody wanted to buy energy stocks. No one wanted to even look at an energy stock. And then what happened next? Energy stocks went on to lead the market in performance for the next 2 years. I believe we are looking at a similar moment here for tech stocks. And what I have on the screen here is the annual fund flows for technology ETFs and mutual funds. And what we are showing here is over the last month, we saw the largest outflows, right? People giving up and selling. We saw the largest outflows in tech that we have seen over the last 30 years. Unprecedented outflows of tech. Folks, this is what capitulation looks like. This is people throwing in the towel saying, get me out. I can't take it anymore. I can't look at it anymore. I don't even want to think about it anymore. This is what happens around bottoms, folks. It's contrarian. I know. Sounds like, why would I want to get in when everybody's getting out? Because unfortunately, retail investors, time and time and time again, they do the exact wrong thing at the exact wrong time. And we will certainly not let that happen to you. So when we look at this, coupled with the way certain tech stocks are behaving, the way that certain valuations really have been compressed of good compounding businesses that have nothing wrong with them, this would suggest to us that tech is far from dead. I believe it's going to have its banner carrier moment over the next couple of years. We believe tech will retake its throne at the top of this market where it belongs. And again, we need some time. This is not going to be a 1-month process, 2-month process. But I believe when you see this type of capitulative selling where everybody is out, there's no one left to sell, folks, right? And at some point, people seeking value and opportunity will return. And I know we're short. It's a very, very small window of comparison's sake, but we're about 2 weeks into the new year, and we've seen a major mood change in this market, right? In 22, nobody wanted tech. In 23, tech's been outperforming everybody else. In 22, everybody was looking at the Dow as the index that was going to lead us home. In 23, nobody's buying the Dow. So things can shift, calendars turn, moods in the market change a lot too, and I think we're witnessing that here today. But again, nobody's going to celebrate 13 days into the year. We got a long way to go, and we're going to take it slow and steady. But we want to share the data with you. I think the data is very important, and we wanted to convey to you how extreme this is, the selling that we've seen in tech. So I think there's opportunities across this market, but some of the biggest opportunities right now, folks, they're in the NASDAQ, they're in the tech sector, because people have just totally written these things off and left them for dead, and we think that they're anything but dead. So if you have any questions, reach out to us. Always here to talk to you about anything that matters with your money. We hope you have a great day and a great weekend, and we'll see you back next week for the Heritage Market Update.